Thank you for joining us for this program on Paycheck Protection Program loan forgiveness. My name is Carissa Miller. I'm the Program and Communication Specialist for Montgomery County Medical Society. I do have a few housekeeping items before we begin. The first is that we have muted participants at the beginning of this call for sound quality purposes. The same with video. To mute or unmute yourself over the phone, press *6. On PC, you can hit Alt-A, or on Mac, you can hit Shift-Command-A. We do ask that you hold your questions until the end of the main portion of this webinar when we begin Q&A. And at that point, you're also welcome to turn your video back on. So the way that we will run Q&A is we'll take the questions that were submitted in advance first, followed by those submitted via the chat feature. And then after that, you can go ahead and unmute yourself if you have an additional question. Today's program will be an update about new guidance published by the Small Business Administration with respect to the Paycheck Protection Program. It will include an important overview about the recently published loan forgiveness application that businesses will be required to submit in order to request loan forgiveness for the PPP loans. We will also review the revised return to work guidelines just published by the Centers for Disease Control and Prevention. This is our third webinar on legal issues related to COVID-19, and we're very fortunate to be joined again by David Shapiro and his colleague Scott Mirsky of the law firm Paley, Rothman. So thank you, David and Scott, for being here today, and we'll go ahead and turn the educational session over to them now.
Great, our pleasure. Let's see if I can make this happen. All right. That looks good. All right. Great. So we want to thank everybody for joining us again today. Scott and I had the pleasure to be here almost exactly a month ago to talk to you about some new information about PPP loans, which is the Paycheck Protection Program. Obviously, there was a lot of buzz about it early on, and the dollars ended up disappearing very quickly, and there was a new tranche of dollars that came out, and a lot has changed since then. There's certainly been a lot of questions, and we are slowly getting some answers out of the government, and now there's been an important next step, which is the release of a loan forgiveness application and some guidelines about that. And of course, these never come out together. So we've had the loan forgiveness application for about a week, and we just started to receive some guidelines on this last Friday. And we anticipate that these are going to continue to receive additional information from the government, and that there will be some more clarity. There's certainly some issues in there that are already a little bit confusing to practitioners. But it's Scott's and my pleasure to be back with you again today. Once we get through that, then we'll also want to touch a little bit on returning to work. So what we really want to do is do a quick overview of what the Paycheck Protection Program is. So when we refer to PPP, that's the Paycheck Protection Program. Then we want to jump into the information that a lot of you are here about, which is loan forgiveness. So there is an assumption for those of you that are concerned about loan forgiveness that you did apply for and receive a loan. And then another thing that I know is weighing on nearly every employer in Montgomery County is how to return to work. And what we'll do is we'll take a look at some guidance that came out of the CDC, as well as some practical guidance that Scott and I have been working with clients on. And then we want to take a very brief opportunity at the end, and you'll see that it is actually relevant to revisit the first presentation that we worked on, which was dealing with the Families First Coronavirus Response Act. And then there's intent that we'll have time at the end to try our best to answer the questions that you have. So just as a brief overview, the Paycheck Protection Program was designed to be administered by the Small Business Administration. The reality is that, and I've said this in each of the other programs, and I'll restate it here, this was not a loan program program by a benevolent government. I think the government understood that there were going to be a tremendous amount of people out of work or unemployed, and the options were to administer this through unemployment offices around the country, which really were not designed to deal with this, but there was also a concern that it would be better to keep people employed, and I use air quotes around that if possible, not only because it provided a different avenue for managing funds, but it also hopefully kept people that had health insurance with health insurance. Initially, it was $349 billion, that's with a big fat B, that was allocated to the PPP program. That money ran out in about 2 weeks. It was then supplemented with an additional 320 B, again, that's a big fat B, billion dollars. My understanding is that we've worked through a lot of that, but there are still funds available. One of the issues that we've had clients dealing with is there are a lot of banks that are no longer processing loan applications. So, I've had one client come up where he decided that he wasn't going to get a loan, came back, decided he was going to get a loan, contacted his bank, and they said, we're no longer processing loan applications. The period that you're allowed to use these funds essentially runs through June 30th. To qualify for the loan, again, and I'm going to try to run through these relatively quickly because this should be some background information. To qualify for the loan, the business had to be in operation as of February 15th, and it had to have had 500 or fewer employees. There were some special rules which I don't think will apply to most people on the call today, but those generally dealt with hotels and restaurants. One other component that may work with some of you, particularly if you're an owner of a medical practice and you also own an ambulatory surgery center, is there are affiliation rules that come into play. And this is essentially the IRS's way of saying that if you own multiple businesses, we're going to treat for financial reasons and financial purposes of this loan all of those companies as if they're one. So if you had multiple entities, you should have, and your accountant probably worked with you on it, those all should have been handled in this program through one application. The program was available to sole proprietors and independent contractors, but there are limitations on what those individuals could use the money for. Let me clarify one point. It's not what they could use the money for. There tended to be limitations on how much they could use of those dollars for themselves personally. Sorry to interject, Scott. Go ahead.
No problem. Hi, everyone. Again, my name is Scott Mirsky. Happy to be with you again. This slide is actually important. It's a little bit of a review, but it's also comes into play during the forgiveness portion, because obviously you need to lump certain things into payroll costs and non-payroll costs. So on this slide, we're giving you a summary again of what's included in the definition of payroll costs. What you can see is salary, wages, commissions, and other compensation, guaranteed payments and profit distributions, as well as vacation, parental and family and sick leave. It would also cover separation pay if someone was under a separation agreement. It also includes group healthcare benefits, including insurance premiums, retirement benefit payments, and state unemployment tax on employee compensation. So that's the definition of payroll costs. And in addition to payroll costs, you also have what's been termed non-payroll costs, which are also covered under the PPP rules, which is generally your business rent, your business mortgage interest, and its interest payments on debts incurred before February 15th. And the same thing with your rent. It has to be on rents or lease agreements that were in place as of February 15th of this year. And it also allowed for you to refinance if you had an economic injury disaster loan through SBA earlier this year. You were able to roll that into your PPP loan. Some of the things that are not included in payroll costs are compensation that you pay to an individual employee over $100,000, which is prorated for the 8-week period covering your loan forgiveness. And we'll discuss that in great detail further along in the presentation of how you calculate the 8-week period. It does not include the federal payroll taxes and income tax withholdings that as well, and the employee needs to be located in the U.S. or their payroll costs are not eligible for the PPP funds. And it also does not include any wages paid to employees who are taking leave under the Family First Coronavirus Response Act, and that's one of the reasons why we want to touch on that act again at the end of the presentation. Some important considerations, just to reiterate, regarding the PPP program is that your loan payments will be deferred for 6 months. Again, that's if you don't get 100% forgiveness and use up your funds during the 8-week period. There's no collateral or personal guarantees required. And again, if your loan is not forgiven in full, then you will have a loan, but it will be at an interest rate of 1% and a maturity of 2 years. So it is favorable economic terms if you don't use up all the funds. Back to you, David.
All right. Some important considerations, and this actually is where we start to get some additional guidance recently, is on the original loan application, borrowers had to certify that current economic uncertainty made the loan request necessary to support the ongoing operations of the applicant. And you've probably heard a lot about this certification that was required. You probably heard about some very, very large companies giving back the money that they had received. In fact, there was a tremendous amount of additional money added back to the pot when some very, very large PPP loan participants decided that they didn't really qualify for this certification, and they actually did return their money. And this is something, particularly as we got towards the end of sort of a grace period that the government had given, that Scott and I were getting a lot of questions from clients about, gee, should we be applying for a loan at all? Should we not be applying for a loan? If we got a loan, but we have some money in the bank, or we had a line of credit in place. So only a week, or I guess it was now 2 weeks ago, the SBA came out with some clarification on this, and the certification still needs to be made. The certification still needs to be accurate, but the SBA and the Department of Treasury essentially gave a free pass to borrowers that received less than $2 million. So now there is a presumption that this certification was made and that it was proper. The reality of the situation is that the auditing of the loan program, when you think about the amount of dollars involved, the amount of borrowers involved, the auditing is simply going to be significantly more of a burden than the government can handle. So if you were in a category where you receive less than $2 million, unless there is an obvious flaw in your application, unless it was clear that there was no way that this would ever apply to you, the reality is that if you received less than $2 million, this certification is significantly less important for you than it was. And the reality is that's the majority of our clients that we've been dealing with. You still do need to provide a certification that the loan funds were used to retain workers and maintain payroll, and for the other permissible PPP loan costs. That's those payroll costs and those non-payroll costs that Scott mentioned a little bit ago. And you're going to see as we get towards the end that there's now a new certification as part of the loan forgiveness application. So let's get into the first part of our meat and potatoes. This will be the meat, and then when we talk about getting back to the office, those will be the potatoes. So this is what a lot of people are really concerned and curious about right now. Ultimately, a borrower is eligible for forgiveness equal to the amount of the PPP loan that the borrower spent during a covered period. I will note here, and I think that we're going to mention this a couple of times, the covered period when the loan program started it started on the day that you received your loan, the money, and it ended 8 weeks later. There has been some additional clarification, which is now an alternative covered period. For purposes of our presentation, we simply refer to this as the covered period. But what was changed was that to make it easier for employers to track the money, They said that if it's inconvenient, if you receive your loan, for example, in the middle of a pay period, and that makes it complicated, particularly with respect to the payroll component of the loan, that you can actually elect to have your covered period start at the beginning of the next pay period. So it's not a huge change, but in terms of tracking dollars, and for people who have received their loans a little bit later and maybe had employees that they wanted to call back or that they wanted to rehire, then it actually created a huge benefit for employers to at least have a little control in the planning. The payroll costs that you use, so that's the part of the loan used for wages and direct benefits, that still has to be at least 75% of the loan amount that you received. So if you've used 75% of your PPP loan on the payroll component, and the other 25% on non-payroll component, and everything's properly documented, you should be fine in terms of getting your loan forgiveness. Now, it's a little bit more complicated in terms of getting the application completed, but that's the concept that was originally in place, was that if you're using the money and you're using 75% to keep your employees employed, and you're using the other 25% to keep the business going, you should be fine. And those other costs are the items that Scott noted. And the key piece is that what's looked at is, with respect to the non-payroll costs, what's looked at is when the agreement that you had for those other expenses, so for example, a lease, when that lease agreement was dated, it had to be before February 15th, and when the payments were made. It has to be used for a liability that is accrued and paid during the covered period. There was an interesting note that came out in the clarifications that payments for utilities such as gas and electric, that those still apply, but there was also a clarification that telephone and internet would be included in that. So that's a big benefit for a lot of you guys who have mobile phone coverage, or you're using very high speed, very expensive internet in the office to keep things working, particularly today in our world of telemedicine. So while you can't use the dollars for third-party expenses, so if you have your internet service and you're watching Netflix in the back office, well, the Netflix isn't covered, but the internet component and the phone service would be. So the amount of the loan that is available forgiveness is reduced proportionately if the business reduces the average number of full-time equivalent employees, and don't worry, we're going to get into this a little more, or the business reduces the wages or salaries of employees in that less than $100,000 a year category by more than 25% during the covered period. And this is going to be compared to the employee's salaries or wages either during the most recent full quarter before the covered period. Now that $100,000 number, again, remember when Scott was discussing with us what we could use these dollars for, they don't take into account compensation paid to people over $100,000. That's on you, right? So you can only get, for even if you have an employee, you may have an associate who's making $120,000 a year, the PPP loan can only be used towards $100,000 of that employee's liability.
Great. So in order to help break things down a little bit and make things a little bit easier, we've come up with some tests that can be used as a guidepost to determine whether or not you're eligible for forgiveness. And these tests are essentially what was used to build the PPP loan forgiveness application that we're going to be addressing later on. But that application can lend some confusion, so we wanted to just kind of lay it out in a more formulaic approach, I guess, a little bit easier. So in a nutshell, if you can satisfy test 1, then you are going to get 100% forgiveness of your loan proceeds, assuming that you use them within the 8-week period and you use at least 75% on payroll. But really in order to get this 100% forgiveness, the easiest way, or the least complicated way, I guess, is that the borrower restores their full-time equivalent headcount and wages to where they were as of February 15, 2020, but restores them by June 30th, 2020. And that's a key date, and that's the date regardless of the 8-week period that you're using for your covered expenses. So it is possible that your covered period could end, June 15th if you got the loan on 2 months earlier. But in order to get this, to satisfy this test, they're going to be looking at your June 30th headcount of this year and the wages that you're paying on June 30th. So as there are some exceptions and other ways to satisfy full forgiveness, but and that would be if you the first bullet, if the amount of the loan forgiveness essentially is not reduced by more than 25% of the wages to your employees. So if you do reduce your employee wages by more than 25%, then or you reduce your number of employees, then you will be subject to a reduction, which we're going to explain in the application. But it's essentially calculated based on the higher of the number of employees versus your wage stability are going to be the two factors that are going to determine whether or not you get 100% forgiveness or a reduction. So again, if your full-time equivalent numbers drop or your wages drop more than 25% to your employees, your forgiveness will also be reduced accordingly. Getting to the different ways to determine your full-time equivalents. And again, we're going to define what full-time equivalent is, but you generally look at the 8 weeks of your loan period, which again could be either the 8 weeks, as David said, the 8 weeks from origination, or your next payroll period date plus 8 weeks. And you need to compare your full-time equivalents to the average number of full-time equivalents that you had during either one of option 1 or 2. So you can use the period of February 15th, 2019 to June 30th of 2019, or you can compare your full-time equivalent from January 1st, 2020 to February 29th, 2020. And again, that would be the time period you can also use to demonstrate that you have met the full-time equivalent obligations during the 8-week period to gain 100% forgiveness. Again, if your full-time employee rate ratios are less, then you will have a reduction in the amount of your forgiveness as well. And again, when you're looking at the payroll cost, you're going to be looking at the amount of any reduction in wages for employees making less than $100,000 and that is greater than 25% compared to their most recent full quarter prior to the covered period of the loan. And that's a mouthful, but essentially you're looking at their wages. If you have more than a 25% reduction of a wage for an employee who made less than $100,000 during your 8-week loan covered period, if compared to what you paid them in the first quarter of this year, then you will have a loan reduction equivalent as well. And that will be another way to reduce it where you're not getting 100% forgiveness. So in a nutshell, you would not want to reduce employee salaries by more than 25% for employees who earn less than $100,000.
All right, so as we noted, last week, the application and instructions were published for this PPP loan forgiveness application. And it basically includes 4 parts, which is the loan forgiveness calculation form and Schedule A to the loan forgiveness calculation form. And then it also includes a Schedule A worksheet. And I use the term loosely when I say it helps to complete Schedule A because it's somewhat complicated. And then it also includes a borrower demographic information form. Obviously, the government would love to know information about who the borrowers are because they are trying to understand, one, that they helped, but they're also trying to understand who's benefiting from these loans. the important part to note here is that parts 1 and 2, the loan forgiveness calculation form and Schedule A, are required to submit to your lender. So you're going to have to give those to your lender. The form, if you want to look it up, and I'll give you a snapshot of it here in a second, but it's SBA Form 3508. And that includes all 4 parts here. I think you'll be surprised. It's only, I think my recollection is that with all the instructions, it's maybe a 9-page form, but the application itself is actually relatively short. Again, I said it does come with detailed instructions. And as I noted at the very beginning, we are expecting additional guidance on this. You know, just this week, I think it was Friday, the SBA issued 2 sets of interim final rules. One which really dealt with the application itself, which was about 19 pages, and the rest you can see. You know, there was a lot. The rest really was starting to give some advice and guidance to lenders in terms of how they need to be reviewing these applications to help marshal through the forgiveness process. So that all said, Scott and I would still recommend, unless you are very sophisticated in terms of finance and your bookkeeping is impeccable, or maybe you're much better informed than us, which would be great because you should join us for our next program. But otherwise, we still recommend working with your accountant. There's a lot of nuance in here. In fact, the questions that I've received this week have all been from accountants, and I think I've maybe had 1 call from client, but otherwise it's from accountants that want to discuss what certain components of the application and in particular the worksheets mean. So there you go. That's the application. It's really that simple. I mean, I'm sure you could probably just print that off and fill it out and send it in. But the second page, which is actually the more important piece of it, I think, is, again, dealing with all of these certifications. So you can see all those bullet points. These are new certifications that you're going to be making to the SBA and to your lender. And don't worry, we're going to get into that. But as I noted, the instruction form that comes with the Schedule A worksheet is a little intimidating. It looks very much like an old SAT question. And in fact, you know, Scott probably had the same feeling I did when I started to look through it. It really does look like a bar exam question. So if you want to know what the bar exam looks like, you can take a look at that worksheet, because it starts talking about 8 different classes of employees and which ones make more during a certain period and which ones make less during a certain period. But this is all actually relevant for what the government is trying to accomplish here, because remember, these dollars, 75% of these dollars have to be used for the payroll component of running your business. And if they are, then the full 25% can be used for the non-payroll component. But the application is still looking at staffing ratios in terms of how you had your business staffed and wage stability. So staffing ratios now have incorporated a full-time equivalent. So where you see FTE in the slides, it stands for full-time equivalent. It now includes a complicated full-time equivalent reduction safe harbor. And then it really still looks at wage stability. Did you maintain your employees that earn less than $100,000 a year at no less than 75% of what their wages were? Again, as we noted, if the IRS or the SBA is still sort of given this free pass to people who got less than $2 million, but there is actually a line right on the application itself that says if you received, or that's you with your affiliates. So again, if you run a medical office and have a separate surgery center, if those 2 entities together receive more than $2 million in funding, you now have to check that box. And I think that the idea is, no matter what the calculations come out at, they want lenders to be able to flag any applications where more than $2 million was paid out. But again, what it really boils down to is what they're looking for on this loan forgiveness application is still whether you used the dollars that you received for the key support areas that the government intended: payroll costs, rent and lease payments, utility payments, and business mortgage and interest payments if you have business property. So I think we just touched on that first part, but there is some additional, this is the second bullet now that we're looking at, there is some additional guidance and perhaps simplification on the instructions for the PPP Schedule A worksheet about how you calculate full-time equivalents. The general rule is if people are working more than 40 hours a week, they're a 1.0. So if they're working 60 hours a week, they're still just one full-time employee. If they are working less than 40 hours per week, then you now have a choice that you can look at in terms of trying to calculate what your staffing is. You can either look at the average number of hours that you pay to your part-time employees per week, or you can just treat those people as a 0.5. Right? So again, we're looking at, did you keep people working during this pay period, or did you reduce staff? But again, they want you to keep your staff. So in terms of deciding where you are on this full-time equivalency for your people working less than 40 hours a week, you can either look at the average number of hours that you paid these people for, or you can simply just say, for all of those part-times, I'm going to treat them as if they were half of a full-time equivalent. The caveat that you have to look at, though, is you have to treat all of them the same. So if you have all of your employees that are working, 0.4, and you can actually treat them all as 0.5, you got to treat them all that way. If it's varied across the board, you may actually want to look at the average number of hours. It's a good thing to look at when you're running your numbers with your accountant. All right, so you can exclude reduction in full-time equivalents in certain limited circumstances, and this is a direct response to concern that a lot of employers have had, and I think my guess is that a lot of you have had. I've certainly had a lot of clients who got their PPP loan, have been looking to bring people back to work, and for a number of reasons, they don't want to come back to work. Sometimes there are legitimate, I don't want to use the word legitimate, but sometimes there are more understandable reasons. Certainly there's anxiety if it's early on in the process. There may be issues with their own health. A lot of people are having concerns that if they're not particularly highly compensated individuals and they're now receiving unemployment, well, they're receiving unemployment plus $600 a week. So we're getting calls from some of our clients that are saying, well, I wanted to bring back 4 of my employees, but 3 of them said they're now making more money on unemployment than they were when I was paying them, and they don't want to come back. So this is in direct response to this. And the key piece here is that your offer to bring them back needs to be in writing. Really, the government wants you to be able to prove that you tried to bring people back, not that you just said, oh, well, I tried to rehire them, they didn't want to come back. So you can, if your full-time equivalent number drops, but you tried to bring people back and you made a good faith written offer to restore their hours or rehire them for the same wages and number of hours, again, subject to the 25, on the wage side, subject to the ability to adjust wages 25%. And that offer was rejected. And this is the second key piece of this, within 30 days of that rejection of the offer of employment, you inform the state unemployment offer about it. Then you don't have to account for people that didn't come back to work after you offered them a job back. So the idea is that there's no double penalty here for reductions in hours that thus triggered a reduction in wages across the board, because you are going to have a dip in wages if you don't have the people to pay. Right, and the idea was there shouldn't be a double penalty. So if that reduction in hours triggers a proportionate reduction in pay, it's not going to trigger the 25% reduction in compensation rule. Okay, I know it's a mouthful, but the real takeaway from this is that if the number of employees you have changed, but it wasn't because of you, right? You tried to bring people back, you tried to give them their jobs back, and they didn't come back, then you're not going to be penalized for that. So this is dealing again with this. With changes in the number of employees that you have. Because keep in mind, one of the key items for doing the PPP program was for employers to keep their employees working. So there's some additional changes. If you have employees who are fired for cause or that voluntarily resign or voluntarily request a schedule reduction, those aren't going to be counted again in that reduction in the number of employees. Obviously, deceased employees, I'm not sure why they threw that in there, but I guess it was to buy comfort level for people, or incapacitated employees, people who can't work due to health or incapacity. You're not going to be penalized for those people not being on your payroll anymore. There is a little bit of a gray area if you have someone who didn't come back because they were ill, but they've now recovered. There is some gray area in terms of whether you would be expected to rehire that employee. All right, Scott.
Sure. So, and the other component is if the wages have stayed the same, and there's some rules regarding how you look at the payroll. It's basically the same rules that for the use of the funds, but just to reiterate, it's, again, it's looking primarily at individuals who make less than $100,000 and the reductions to their salary that you make accordingly. And just some clarification has come out regarding how that $100,000 number is looked at, but essentially it includes the wages and their paid leave would be forgivable, assuming that everything else is you use it in the 8-week period and meet all the other requirements. Now, there is one exception to that, leave that's taken under the Families First Corona Response Act, which we're going to get to separately, but the leave under that act is not part of the forgiveness and would have to be handled under a tax credit separately, which we're going to discuss briefly at the end of the presentation. When you're also figuring out how you hit the $100,000 cap, you don't have to look, if you do pay health benefits or retirement benefits, while those are forgivable costs under the CARES Act or under the payroll protection process, you don't have to, that would not bump someone into being paid over $100,000, all because you look at their health benefits are treated separately. They are forgivable, but they're not part of the $100,000 threshold. We've also learned that you can pay people a little bit more than you were paying them pre-coronavirus if you wanted to, and that would also be considered legitimate payroll costs. Either some sort of bonus or hazard pay is acceptable if you want to, but again, you still would not, the $100,000 pay limits would still apply. The other thing that we learned from the regulations is that it typically looks at the date the employee earned the pay and the date that it was paid to the employee. Usually that's the pay date or when you originated it, if it was done electronically. So those are going to be the critical dates when you're determining when the payroll costs were made to your workers. Now, again, and we sort of touched on this, but we also learned through this, through the recent guidance, that you can use the alternate payroll covered period. And David briefly alluded to that earlier. And again, when you're looking at your 8 weeks for forgiveness, this can either be the 8 weeks from the date of origination of your loan moving forward, or you can shift that to your beginning of your next payroll period and use the 8 weeks going forward from that date. Now, we also learned that there's some restrictions regarding owner's pay. And again, they're capped at the lesser of $15,385 or the 8-week equivalent of applicable compensation in 2019. So there's those limits, again, when you're dealing with the forgiveness. And there's no forgiveness for retirement contribution or health insurance benefits for self-employed individuals. So this is specifically talking about self-employed individuals. It's different for your workforce if you're part of a larger entity. We also, rent, just to discuss, has always been permitted as an acceptable use of funds and forgiveness as a non-payroll expense. We also learned that it covers personal property leases as well. So you can check your leases for copy machines, lab equipment, et cetera. But again, those leases would have to be in effect as of February 15th, 2020. And again, your payments for those lease payments would go under non-payroll expenses. And again, that's limited to 25% of your total forgiveness. So it may or may not impact you depending upon how much rent you have. If your rent may cover the full 25%, but if not, you can look to these other areas to see if you have any additional costs that you can use to help get you closer to 100% forgiveness. On interest, we said that you can obviously use it for interest on business mortgage obligations for real or personal property. Again, the critical date being that those obligations were in place prior to February 15th of 2020. No, we're definitely not suggesting that you can't use it to prepay any principal, but you can use it to pay accrued interest on your loan. Utilities, as David said, it covers electricity, gas, water, transportation, telephone, and internet access, and it should also include your mobile phone service that your business pays for.
Great, thanks, Scott. As I noted, you now got this little freebie, and you can relax about the certifications that you made in your initial application if you receive less than $2 million. But there's that whole second page of the application is a whole bunch of lines that you have to sign off on to your lender of new certifications. And basically what it says was that the funds were used for proper purposes and that the calculations were complete, and that the measure period, that's going to be that either the 8 weeks after the loan origination date or the 8 weeks after the next payroll period, that those periods are accurate. If dollars were misused, the government can try to recover those dollars from you in the future, and of course they may seek civil and criminal charges. There are probably bigger fish out there right now, so I think a lot of enforcement efforts are going to be looking at people who got more significant loans than the typical business, but that doesn't mean that you don't have to be careful with your certifications. And of course, you have to certify that all information is true and correct. So this takes us back to our comment that we do encourage you to at least talk with your accountant as you go through this process, because if you and your accountant have sat down together and you've worked through the worksheets and you're filling in the application with the information from the worksheets, you should be able to make these certifications without a lot of stress. So the penalties, obviously the penalties can be significant. It really depends on which law the government decides to allege that you violated. If it's for giving false statements, the penalties could be imprisonment for 2 to 5 years, again, depending on the statute, or fine from $5,000 to $250,000. However, there's sort of a more potent crime that could be involved, which is submitting false statements to a federally insured institution. Remember, most of these statements that you're making are to a bank, and it is highly likely that that bank is a federally insured institution. So in that case, it's just a walk in the park, up to 30 years in jail or a fine of not less than $1 million. Obviously, we primarily included this just because we liked the little graphic on it. Don't forget, there is still a benefit where employers can delay paying their 2020 payroll taxes. You can put off half until the end of next year and half until the end of the year after that. However, I know that sounds great. Again, talk to your accountant about what that really means in terms of cash flow. If you have had a little bit of a reprieve from payroll costs and rent costs for the last couple of months, and you have a relatively small payroll and you have the ability to pay it now, there may be some benefits to paying it now, but a lot of that's going to depend on what your reopening and your return to normal in terms of patient volumes looks like. But don't just do it to do it. Make sure that you do a quick analysis to see if this is something that in fact is going to be beneficial for you. There has been a lot of discussion, and we're still waiting to see. There actually was a new draft legislation that came out, I think, today or yesterday evening, about the next round of aid that may be coming out of Congress. But there has been a lot of discussion about whether this calculation period, this 8-week period, was too short. I think that there were a lot of people who assumed that the virus would take a much faster course than it did. I think that they've, for the most part, been proven wrong, and that it really wasn't reasonable for the government to encourage people to stay open the best they could for 8 weeks when we're not ready for revenue to start flowing back in the door on the 9th week. My sense is that this may be coming, but I have some concern that it's a little too late. It makes it very, very challenging, and there's even a question of whether it's unfair to businesses that got their loans early. I think it's probably more likely that we'll see some sort of supplemental type loan package if that's where things are going. The other thing, and this is, we think that there are probably a lot of layoffs coming. My sense is that there are a lot of people who kept people employed simply because they had PPP dollars. So, the reality is that we anticipate, and this is more on the legal side of things, but we anticipate that we're going to be seeing a lot more layoffs, which means that our unemployment system is going to be getting stressed again. And I think that the government is concerned about that. So they are looking to see how we can avoid having, in the next couple of weeks, a huge new tranche of people flocking to the unemployment offices. Because remember, if you were very early in the PPP process, we're at the very tail end of your 8-week period. People who are very early in the process, while they may be able to adjust whether they use the loan period from when the loan originated or the next payroll period. The reality is that information wasn't out until very recently. Most of those people started using those PPP loan dollars for payroll purposes starting very early. So we're coming to the very tail end. Their 8 weeks is almost over.
Great. We're going to shift gears quickly. I know we probably have a lot of questions regarding the PPP loan forgiveness, but we thought it's important to just discuss some general return to work guidelines, just because there has been some updates, some stuff that we've received from the CDC, and to try and educate as much as possible. We wanted to share this information and give some practical tips, because along with the PPP issues, you have the practical issues of running your practices. So originally, as you may have heard, the CDC was going to release extensive guidelines regarding return to work. And then I think they got some resistance from the president, and they offered essentially this one-page sheet, which is available on the CDC's website, which basically gives you very, very limited information regarding when you should or should not open. And it essentially just boils down to whether or not you can put in place, the appropriate social distancing, cleaning, wearing masks, and hygiene. And again, this obviously would deal with, I know a lot of your practices are already been open for seeing people. I think that then in this case, this would be the guidance to bringing back your entire workforce if you haven't already done so. But again, you have to go through each of these steps, and if you continue to say yes to all the questions, then you eventually get to this point where you're at open and monitor. Now, last week, we did get additional guidance from the CDC, where they did issue I think it was an 80-page guidance, which is also available on their website. And David, if you can just flip to the next page, it essentially did not just deal with, it dealt with a lot of different things. It was guidance for daycare, schools, restaurants, and essentially businesses with high-risk workers. So again, it's kind of doesn't really address every situation, and they essentially put things into different categories about scaling up, safety actions and training, what your cleaning and hygiene and social distancing should be done, and essentially monitoring and screening, and then what are you going to do? You need to have a plan in place for what happens if someone does get coronavirus in your workforce, especially if they somehow was being spread in your office. You need to be prepared for how you're going to handle that. And they broke it down into 3 gradual steps, which are on the next slide, David, where when you first reopen, that you would restrict social distancing, or I'm sorry, require strict social distancing. So at first you will say that no one can get within 6 feet with another individual. Again, I guess to the extent that that's practical, and wearing a mask. The second step moves more to moderate social distancing, and then the third step discusses how you get to a limited social distancing workforce. And again, all the steps focus on healthy hygiene, strict cleaning protocols, social distancing, limited travel, modifying commuting practices, monitor, preparation, plan, and to be prepared to close if necessary. And that really is the overarching guidance regarding return to work. The main things that we're stressing to our employers or our clients is that you plan and prepare, that you communicate and document what your plans are. And this should be done even before you bring the workforce back. It should be very clear what your company is planning to do and how the phases are going to work. Then you want to implement your plan. Then you need to closely monitor your plan, and then again, be willing to adapt if the situation arises. We've tried to put things into different buckets of consideration: the practical, the legal, the financial, and the existential. Again, because there's practical issues that everyone has to deal with. Employees that have to take mass transit, employees who have left the area of the country. You have the financial issues regarding the impact of your planning decisions on PPP loan forgiveness, and if you're going to lay off workers and when you're going to do that, and is it during your 8-week period? Is it going to be after June 30th? Which I would strongly suggest not laying off anyone until after June 30th if you're trying to get maximum PPP forgiveness. You have legal issues regarding business liability and discrimination claims, and there we suggest that you just have neutral policies on how you're going to bring the workforce back together. You can do it by different groups or different practice areas or different categories, but again, you want to make sure that you're not doing anything that could be perceived to be discriminatory or unfair to a particular protected group. And then, of course, you have to weigh the impact of reopening your business, the image, the reputation, and how that will be viewed within the community. And then David has some practical considerations as well.
Sure. It's, a lot of the guidelines that we got from the CDC are science-based, but, a lot of what Scott and I are concerned about when we start talking with clients who are looking about reopening are legal and liability based. So there are practical issues. The first one that I'd want to flag with you, which is something I think very few employers are thinking about right now, is be mindful of growing vacation accruals and liabilities. And what I mean by this is you may have a large workforce right now, or you may even have a small workforce right now who's not necessarily coming into work every day or is working an abbreviated schedule, is getting paid full time or with a slight adjustment because you've received a PPP loan, and they're not taking vacation that they otherwise would have been taking this time of year, and that's particularly relevant in the upcoming months. So you could be in a situation where those individuals are still accruing vacation, they're not using vacation, that if you have a policy with your employees, for example, that upon termination from employment, you pay out accrued but unused vacation, you could be starting to build a big financial liability down the road. So one of the things that we recommend to employers, this is even if you're not open right now, but you're still employing people and you're still paying people, is consider implementing leave policy changes now. You know, I know very, very large companies that have implemented rules that say, you know, we're requiring all of our employees to use 10% of their available leave per pay period. I know smaller companies that have said, if you have more than X hours of leave, we're requiring employees to take 1 day of leave per pay period. Obviously, they're the same rules and concerns that Scott mentioned about not being discriminatory in how you put these rules in place. But it's something to be mindful of, because I think that we're going to have a lot of businesses that are going to start to reopen over the next month or two. Right? They have a lot of people sitting on a lot of vacation. We could be back to, you know, hopefully business as usual, or something business at least as new business, but with people fully working in, say, the beginning of September. And then you could have employees that go out for 2 or 3 weeks that, one, you lose the productivity of the employees, but also you lose the dollars because you're now paying them out of your own pocket. Something to think about. Also, start thinking about scheduling and facility changes in advance. You want to help control, to the extent that you can, physical distancing and people flow. So for example, you've probably seen that in certain buildings, there's no more than 2 people per elevator. Some buildings have elevators stopping on every floor so people don't have to push buttons. If you have an office with multiple entrances, you may want to make your office one way. Everybody comes in one way, goes out another way. You may want to restrict areas. So for example, you know, as Scott and I start looking at opening up our office to our employees over an extended period of time, we may decide that we don't want our cafe open. Right? Our cafe is really designed as a place where people can go and they can have lunch together and they can, you know, pick up a cup of coffee. We may decide that we want those things to be much more limited. And then again, touching on Scott's point about how important it is to be able to help and track people, we've had in place for a long time. You know, most of us work remotely these days, but we've had in place for a long time. Anybody who goes into our office, whether it is an employee, whether it is a contractor, whether it is a guest, they all have to sign into a logbook saying the date, the time that they were there, how long they were there for. It's important to have that information available to you, because if we find out that someone was sick, we can look back and say, well, that person was in the office on the 5th. So people who were in the office on the 5th, we probably want to be in touch with.
Right. And again, just a reminder, you would not want to if someone does contract COVID, you can't publicize their name to even your employees. You would contact the other people that were exposed or potentially exposed, but you wouldn't be able to release the specific name of the individual, or else that would violate HIPAA and a host of other rules, unless, of course, the person consents to it. We did want to talk briefly about telecommuting as an option. You may still have some workers in your office certain days of the week and telecommuting other days of the week. Our general guidance has always been that you should have a formal policy, a teleworking policy. We sort of got away from that back in March and April because everyone was teleworking. It was just really difficult to get a teleworking policy in place. But now that things have relaxed, or we may be seeing telework happening or telecommuting going on for a lot longer, we do suggest that you have a formal policy. We put some bullets down of what should be in one, but how telecommuting decisions are going to be made, how certain jobs may or may not be suitable for telecommuting, how equipment is going to be handled, how long it's going to last for. You also really want them to confirm that they're going to continue to abide by all company policy, job duties, work hours, because you could run into an overtime issue if someone's working at home a lot of hours, so you need to address that. Child care issues, possibly safety issues, technology issues, and confidentiality issues all need to be addressed in a telecommuting policy. So if you're going to use telecommuting either as a partial or limited solution going forward, you should think about communicating your policy to your workforce.
All right. So, you know, the other practical considerations are, you know, partial work weeks may be available for some employees. That's one of the things that we're looking at. You know, you may have a situation where someone can come in a certain days a week and be in the office, but work remotely the other part of it. We're also looking at office layout. We may want to have people who are on one side of a floor there one day, who are on another side of a floor there another day, and on a different part of the floor there even a third day. And we also want to think about whether or not we should have groups of people. And so, for example, what might be beneficial for us is, let's say that I'm only in the office the days that my legal assistant's in the office, right? Because really I'm not particularly productive without her. So if she's there, I should be there. And if she's not there, maybe I should work remotely that day as well. So there are strategies that you can start to think about now in terms of how you're bringing people back. You may have multiple employees that do the same thing in your office. Maybe they're not there on the same days. Again, this is really just practical ideas for you to start bringing people back so you can then try your best to adhere to the recommendations from the CDC.
We did want to talk briefly about some other practical considerations: testing your employees and guests, temperature taking, body scans, antibody testing, self-evaluation forms are all things that have been sort of suggested and looked at and considered. But right now, the EEOC, which is the agency that looks at deals with Americans with Disabilities Act and discrimination statutes, at the time being, I guess, while there's still a pandemic going on, has sort of said it's okay to take temperature taking of your employees and test them for COVID-19. I think that there's still a lot of practical issues on how you're going to do that, how you're going to safeguard the information, how you're going to comply with HIPAA, who's going to do the testing, and a lot of logistics. So we're not necessarily suggesting that as an option. I think if you do, you need to have a fairly robust plan in place on how you're going to handle that. A self-evaluation form is a lot easier because the person would then, at home, you can ask your employees to take their temperature before they come to the office and not report if in fact they have a high temperature. Is sort of the safer way to go. I understand you're in medical practices, so there may be a need to do heightened testing, but again, you should have a robust plan in place. And the final issue in this section is just travel issues. Again, if you do need to travel for work, we suggest that it's only essential travel for business purposes. But we also are starting to get a lot of questions about what happens if an employee travels to a hotspot or attends a large gathering or even goes to the beach over the weekend. You need to be thinking about, are you going to allow that person back into the office, and what are your rules regarding that sort of situation? And these are things that you probably need to lay out now when you're communicating with your workforce on how those individuals, how you're going to handle those situations before they come up, and maybe employees will think about not going to the beach if it means they're not going to be able to come to work. But again, you also have to look at discrimination issues and a host of other legal issues to make sure that your policy is fair and not discriminatory.
So we had a very quick review at the beginning about what the PPP loans are. We've looked a little bit more in depth into the loan forgiveness application, and we looked a little bit more in depth to some of the guidelines that have come out from the CDC, as well as some practical considerations that Scott and I have been working with our own clients on. I do want to take just a couple minutes here, and I know that we were hoping to, I'm about 3 minutes over from when we wanted to turn this over into Q&A. But I think that this is an important topic for us to review, because I think that what many of you may find as you start to reopen is that there are still a lot of practical issues out there. For example, childcare, right? So you'll recall, and if you weren't at the first presentation that we did with the Montgomery County Medical Society, I think that you can still access that data, and you should certainly contact the folks there. I think that at that point, my partner Jim Hammerschmidt and I did a much more in-depth dive into the Families First Coronavirus Response Act, which is what we refer to as FFCRA. But I just want to give a little bit of a background, because I do think that there are going to be situations for many of you where you reopen and you have people that may still be eligible to use leave that was made available way back then in April. So those rules are still in place, and you may have employees looking to participate in some of these extended leave benefits. I probably jumped too quick. So there are two pieces of extended benefits. One was the Emergency Family and Medical Leave Expansion Act. This was basically expanded FMLA, and the other was the new federal paid sick leave law. So the Emergency Family and Medical Leave Expansion Act, again, another acronym, this covers employers with 500 or fewer employees. So I suspect that that's almost all of us on this call, certainly us. For employees that were employed for at least 30 days, right, they had to be employed for at least 30 days to be eligible to participate. And this applies when an employee needs leave for the following COVID-19 reasons. It really only applies in this instance, but I think this is what's going to be practical for most of us, is that they have school closures or childcare closures. I don't know for how many of you are in the same boat that I'm in, but we're getting emails from our children's camp on an almost daily basis saying, we miss you, we love you, but we're not going to open this summer. So, you could be great and donate your money to us, or we can talk about how we can pay you back at some point in time. But I think this is an issue that a lot of us are going to be dealing with. The employee would be entitled to 12 weeks of leave. The first 10 days would consist of unpaid leave, right? And that's, it's obviously subject to any other leave benefit that the employee may have. And then the employee would be paid at 2/3 of the employee's regular pay rate, up to $200 per day per employee. So it's $10,000 in the aggregate per employee. So there is a cap, but it's a pretty high cap. There are some exceptions to this, right? So you certainly can ask for an exemption. And the standard exception that they're looking for is that to participate would jeopardize the viability of the business as a going concern. Simply put, the business just simply couldn't survive if we had all of these people to pay out under this program. Again, I'm going to jump over this. There is information available. You can certainly call us on this, but this wasn't sort of the key topic. It was just something that Scott and I were concerned that a number of you were going to start to see.
And just to quickly run through the last few slides, this is the other part of the new act, which covers employers with 50 or fewer employees. Essentially, you get 80 hours paid if anyone fits into items 1 through 6, which is essentially someone who is either sick with COVID-19 or COVID-19 symptoms, or taking care of someone who has the symptoms, and or needing childcare due to closures related to COVID-19. And again, this would be 80 hours for full-time employees paid sick leave that the company would have to provide. Moving on to the next slide, there's caps. We can just leave them, let them speak for themselves. Again, there's a similar exception to what David said about jeopardizing the viability of the business. There is a pretty major exception on the next slide, that certain types of healthcare workers are excluded from the Families First Coronavirus Response Act. It's very broad, so it is possible that some people in your workforce are not entitled to this. However, the Secretary of Labor says that you should encourage or use this act liberally and try and accommodate as many workers as you can. And there may be certain exceptions where you should provide them the benefit, even though they technically may fall outside of the covered group, but you should still do your best to provide them with the 80 hours or the child care leave. And again, if you use any of these benefits for your employees, you are entitled to the tax credit, which is explained on the next slide. And again, that's what we were saying. The reason we wanted to tie this all together is that if someone is out on leave associated with FFCRA, you shouldn't be using your PPP dollars for that person's leave. Instead, you should be applying for the tax credit for the leave associated with FFCRA leave. I think I got it, David.
I thought that was great. I think that those last two slides have a lot of critical information here. So
All right.
okay.
Thank
Carissa, do you
you
want me to
both.
turn this back over to you, or you want us to leave this slide up for the time being?
You can go ahead and leave it up. That's fine.
Okay.
I'm going to start with the pre-submitted questions that we have. So I'll just dive right in because I know we're a little short of time today. The first is about how a forgivable SBA EIDL loan advance changes the PPP loan forgiveness. For example, if the practice got a PPP loan of $137,000 and an EIDL loan advance of $10,000, how much of our PPP loan can be forgiven?
So, and Scott, you can correct me if I'm missing it. If you simply received the initial $10,000 grant under the EIDL, they should not be related. What happened when we saw this change due to COVID-19 was most people who applied for an EIDL loan early got a grant of $10,000. It could have been limited if your loan eligibility would have been less, but with $137,000 PPP loan, the EIDL loan probably would have been larger than that minimum. So that $10,000 should be treated as a grant and would not actually come into play with respect to your PPP loan forgiveness. The caveat to that is that you can't really double dip. So if you did get an EIDL loan, you could use the non-payroll portion of your PPP loan to repay that EIDL loan. But I know that's not the question here, but if you only received the $10,000 advance on the EIDL loan before that program ran out of money, that should be treated as a grant. You should look at what you received, and it should not be applicable with respect to your PPP loan forgiveness.
Okay, thank you. Is an employer retirement profit sharing payment to employee 401k accounts to fulfill and complete 2019 safe harbor requirements in conjunction with filing a corporate tax return an allowable PPP use and a forgivable payroll expense if made during the 8-week period?
So the answer is, there's two parts to this. The general answer is that contributions to standard retirement and profit sharing plans are permissible, and those dollars, you can use PPP dollars for that. That would come out of the payroll portion of that. What I don't know in terms of that question, and it may be something that you want to ask your accountant about, is if your annual contributions are not due yet, I'm not sure if you could prepay those using the PPP dollars. So the simple answer is, if you have a general, so not a top hat plan, not a plan for very highly compensated individuals, not a plan that is, like an ESOP or an unusual kind of plan. But if you have a traditional profit sharing plan or 401k plan, my understanding is that the contributions that the employers make on that are permissible for use with the PPP dollars. The part that we would encourage you to ask your accountant about is if you can change the timing on the payment of those. My understanding is it was just ordinary course payments that came up during your covered period. But if the irony is that you're making all of your payments in a lump sum each year for the employer share, I don't know if the timing of that would have to be looked at in terms of the covered period. Scott, have you seen anything on that?
No, I haven't, but I guess it, yeah, no, I sort of agree on your analysis, but I haven't seen anything else.
Yeah, so the simple answer is yes, you can use your PPP dollars, but there is possibly a timing issue on it that we would encourage you to speak with your accountant about.
Okay. Regarding payroll costs, can a practice include new consultants or independent contractors in the PPP monies?
Yeah, that's a very good question. Independent contractors, no, they would not. It only would be for employees. There would not be any, because an independent contractor or someone who's self-employed would be able to apply for their own PPP loan. So you would not get forgiveness, or I'm not even sure you could use the funds
Right.
for an independent contractor. But it's a very good question.
Okay. If a practice pays out payroll on the 1st and the 16th of the month, what is the date that they should use in dispersing PPP monies towards payroll, since June 30th is not a payday for them?
Is that one of the typed questions? I'd like to hear that question again, make sure I have it.
Yeah, it's the second one in the chat, and
Mhm. This is if our coverage period spreads April through May.
yes.
Um,
Nope, the one above.
okay, so that one's
I'm
not
not, I'm sorry.
in my chat queue. So if you could just repeat the question, I will try
Sure.
to.
If you pay on the 1st and the 16th of the month, what is the date, as June 30th is not a payday? What if you never closed?
Okay, so that's a great question. You know, I think that for anybody who has received their dollars already, they should fall within that 8-week period, right? Because if you receive your dollars today, for example, your coverage period should run out by the end of June, all right? Because you would have 8 weeks from today, which would be essentially all of, oh no, I take that back because June and July. Um, I see what the question is. So I have not seen anything about the period extending beyond June 30th. Scott, have you seen guidance on the period extending beyond June 30th? Because that is actually, it's a great question, because when the original statute was written, it was not contemplated, even though it should have been, that there was going to be a second wave of
Right.
loans coming in, and thus loans that were coming out this late in the process. I suspect that we are going to get additional guidance that says that if you received your loan now, for example, if there are still dollars left and loan dollars are still coming out, that you will still have 8 weeks to account for it. I don't think,
Yeah.
I've not seen any suggestion that that is going to be a compressed period. However, I have not yet seen that guidance, and I suspect it will be coming out, because that is a very fresh question, simply because dollars are still available, which was never anticipated when the statute came out. But the idea is that if that's not the exact question, it really had to do more with the fact that June 30th isn't the 1st or the 16th. I think that what you would want to do is, because that could be the other question, right? So if you have a payroll that's due June 1st, which means that as of June 1st, you're basically paying for the previous 2 weeks, right? June 17th through August 1, for example. I think that there is an allowance in the statute, if you use electronic funds to fund your payroll, that you can use the date that those electronic funds were issued or executed. So you would want to make sure that your payroll is paid using electronic funds prior to June 30th, and that should put that entire payroll within the pre-June 30th period. But again, I think that we'll probably see some relaxation on that June 30th. We just haven't seen that yet.
Okay, great. If our coverage period spreads April, May, and early June, can the company pay health insurance for all 3 of these months?
So the answer is you can include any health insurance premiums that you would have had to pay during the covered period. So it is unlikely that you would be able to pay April, because most of us pay that cost at the beginning of the month. So if you paid everything on April 1, it is unlikely that you would be able to cover that cost. However, you should be able to cover the costs that you pay in May and June, since those are both paid during that time period, and paying for health insurance premiums for your employees is a covered expense.
Under non-payroll costs, is the lease on vehicles covered?
That's an interesting question. I think the answer is somewhat in the gray area. If you were talking about a personal vehicle to the owner of the business, I think that is going to be a very, very hard sale to make to the IRS. If you were talking about a commercial vehicle. So, for example, you run a pathology lab and you have, 8 cars that you have employees driving all over the place to pick up samples. Those vehicles should be covered, the payments that fall due within that time period. I have not seen anything about, one, as a general rule, you shouldn't own cars in your entity just because of liability reasons. So if you still own cars within inside your entity, you might want to rethink that. So that aside, which has nothing to do with this program. If you are talking about business vehicles, though, for example, the cars that people are using to pick up specimens, the lease payments on those cars should be included.
Can you clarify how to prorate an employee paid greater than $100,000?
Scott, you want to take that?
Well, you wouldn't. I'm not sure what the question. Did you understand the question, David?
I think that the question is what you're doing with respect to paying your people, and this actually, right? So people paid over 100,000. Really, in terms of what you can pay the individuals, that doesn't change. Right. So if you have an employee who's making over $100,000 a year, you may continue to pay them over $100,000 a year if you have the ability. Of course, obviously, we would all love to continue to pay our people, but most business are experiencing some dips in revenue. That being said, in terms of where that falls into the PPP loan program and the forgiveness analysis, the maximum amount that you could claim as paid to that individual it's approximately $15,300 or so. So the real issue is that you are looking at the cap at $100,000. You would divide that by 12, and the number comes out somewhere in the area of $15,300. That's the amount that you would be able to claim for the loan forgiveness. Anything paid above and beyond that would be ineligible for use of PPP dollars and ineligible for forgiveness.
Okay, thank you. If an employee who was full-time in the first quarter takes a PT job elsewhere and then reduces their hours by 75% with you, will you be penalized? Will it trigger the less than or the greater than 25% reduction? Do you need documentation?
I think by PT, we are not talking physical therapy here. I think we are probably talking part-time. If they take a physical therapy job, let's hope that they're licensed. But otherwise, I think that the simple answer to the question is that if they reduced their hours on their own, although it looks like that reduction took place prior to this period, because they're saying they were full-time until Q1. Everything here has taken place in Q2. So the answer is that it should not. That's an unusual scenario. I would think that it would fall within, normally it would fall within the analysis of someone who voluntarily reduced their hours. However, the complicating factor in the question is that when the coverage period started, they were already only working part-time.
Right.
And so I think that if you're concerned about what the measurement period is, because you had another 0.75 employee on the Q1 period looking back now, I don't think that that natural change in hours should be factored in. But again, that's the kind of question that I'd want you to ask your accountant about when you're filling out the worksheet to the loan application. Only because the time period that you're looking at.
And we should clarify, when you're looking at the full-time equivalent ratios, you don't need to bring back the same exact employee if you're trying to satisfy the ratio. So if you lost a full-time employee and you rehired another full-time employee, you would still be at the same level. Doesn't necessarily need to be the same exact employee, just if there was any confusion regarding that.
Okay. If a practice across the board tells their staff that on the honor system, if you go to the beach or another hot spot, that they should make the practice aware of their need to quarantine, and because it is across the board, there is no discrimination there, correct?
You maybe not. It depends. I mean, it depends how you're defining hotspots, and that you're not, and if your hotspots are in the country or out of the country, because you could potentially run into like a national origin discrimination. I think if you're using like a CDC list as what you consider to be the hotspots, you're probably okay. But if you just decide, well, India is too close to Italy to take a chance, so I consider that a hotspot, I think you would probably run into a problem doing that. I think if you're, depends where you're getting your information from and how secure you are, that those places are really considered hotspots.
Okay. So our next question asks, I was under the impression that the employee's portion of federal payroll taxes, what is withheld from their pay, was considered an appropriate expense, just not the employer's portion. Is this correct, or none of the federal taxes eligible?
So this is a great question. This is actually a question that I was speaking with an accountant about this morning before the program, because there is some level of disagreement among the accountants that Scott and I have spoken to on this issue. The general thought here is that, employees pay all of their income tax, right? So there's the payroll part, there's the income tax part. So I think the reason that the statute is worded so awkwardly is that there's really no consideration given to income taxes, because you simply withhold your employees' dollars and submit them. That brings up this second piece in terms of payroll taxes. What the statute has made clear is that any taxes that are assessed by a state or local government that are based on what you pay your employees. The key example there is unemployment. Those are included in what's covered under the PPP loans. There is disagreement in terms of the federal payroll tax. That's basically going to be the FICA piece of it. Our sense initially was, and Scott, you can chime in. Our sense initially was that the FICA type taxes, the employer's part would be included, but we've been told by a couple of accountants that they are not including any of those in their calculations because they deem that to be a gray area. So I wish that I could give you something more definitive. Scott, I don't know if you've heard something different, because I'm hearing both things in terms of what the accountants are telling me they're looking at in terms of the worksheet.
Yeah, I mean, I agree with you that my understanding was that the employee's side was forgivable, but not the employer's side could not be used as payroll costs. But I think that we need further clarification from the SBA on that one, or the IRS.
And I don't know if the reasoning behind that has to do with the deferral piece where you can defer payroll taxes. And, I'm not sure if it's all lumped in, but, it's certainly worth speaking directly with your accountant about this. If I'm getting varied responses from the accountants that we're working with, I suspect we're going to see some additional clarification on that point as your accountant starts to sit down and fill out that worksheet, because I do think that Treasury and the SBA are going to start getting a lot of questions about this, and the IRS is going to have to weigh in.
Thank you. Our next question asked, is interest on any business loan initiated prior to 2/15/20 eligible, or is it only business mortgage interest?
My understanding is that interest on business loans that were in place prior to February would be eligible, but it's only interest that you can't prepay interest. And if you were behind on interest payments, you could catch up because arguably those are due. But my understanding is that for ordinary course business loans that are in place, that the interest payment could be included. What we've noticed is that the information that's coming out now and guidance now is much more narrowly drafted than it initially was. So I don't believe there's been a change in that. Scott, have you seen anything in terms of a change in that?
No, I mean, there's just the definition of non-payroll costs, which doesn't really address, they define business mortgage interest payments as covered mortgage obligations on
Right.
any business mortgage or real or personal property. So I think it would have to be on real or personal property to be forgivable.
Yeah, and it's certainly become over the last, I think 3-4 weeks, that has become a narrower definition in my mind. But again, that's really a calculation question for the worksheet. So, as you and your accountant are drafting up that piece of it, it's certainly worthwhile to raise that issue, because originally we were under the impression that interest was a permitted expense, but the individual who asked the question is really tapping into a very good issue, because that is something that seems to be more narrow now.
Okay. Um, can a practice use its PPP funds for a 1099 employee as part of the 75% payroll eligibility?
Yeah, no, you wouldn't be able to use any payments to an independent contractor. You wouldn't be able to even use it for PPP purposes.
Right.
Is that during?
The idea is that people that you're paying as 1099s are independent contractors, and thus they would be eligible to request their own PPP loan.
Okay. And then this is our final question. For math purposes, $100,000 plus employees paid monthly comes to $8,333 a month, or $16,666 over the 2-month period. But an employee being paid bi-weekly gets $76.92, or $15,385. Can we do it both ways?
Well, if I could do math, I would have been a doctor. So I think, I
No,
didn't
I
know there
think
was math involved. But go ahead, Scott.
Yeah, I mean, I think I think it has to be the 8 weeks. I think what you're alluding to is you're sort of you're looking at it, I guess, from as 2 months instead of 8 weeks, and I think that's not the way that the payroll period really. I mean, that's not 8 weeks. You're limited to 8 weeks under the definition.
I agree. And I think it's important to note that all of the calculations and all of the guidance and all of the formulas for measuring the loans are done on an 8-week basis and not on an annualized basis. I think the only reason that there's some confusion with respect to this issue is because the government has put in place this strict $100,000 cap. So, but when the government did the math, it is the $15,300 amount that the government is using in all of their examples. So I would agree. I think that you really need to be using that second number in the question.
Yeah. I think it'll be a red flag if you use the other number, if anyone does an audit.
All right. Well, thank you for those responses, and to our audience for a list of really fantastic questions. We will make this webinar available online via our YouTube channel. Don't forget to subscribe to our channel for other educational content, including webinars on telemedicine, remote patient monitoring, and telehealth billing during the pandemic. We've also dropped the link to the original employment law webinar that we did with Paley Rothman into the chat, so that's available to you via YouTube as well. I do have a few things that I just want to let you all know about before we end the call today. The first is that MedChi continues to coordinate all clinician calls with Howard Haft, MD of the Maryland Department of Health, on COVID-19. The schedule has been adjusted beginning this week, so it'll be just twice a week going forward on Mondays and Wednesdays at 5 p.m. And you can always register for those calls on our website, montgomerymedicine.org. Our next webinar in this series will be our OSHA update for medical practices. It'll be on June 3rd. We will have Tony Jagielski from the Maryland Department of Safety and Occupational Health. It will be a members only program, so keep an eye out for that registration link. It'll also be sent to you via our post-event email. And then finally, Montgomery County Medical Society launched bi-weekly calls with Montgomery County Health Officer Travis Gales 2 weeks ago. Our next call will be on June 3rd. The recording from our original call is available online. So visit us at montgomerymedicine.org/events to access both the recording and the upcoming call. So I'm going to end our session there. I just want to say thank you again to everybody who dialed in today, and also to our speakers for providing us, as always, with such excellent information.
Yeah.
Great. Thanks, everyone.